Our last podcast commented upon the US economy and how we were seeing deteriorating data, and the podcast took place just prior to the publication of the non-farm payroll number, a number that was eagerly anticipated and came in very disappointingly lower than expectations. So there has been that continued theme of whether or not the US is technically heading back into recession or whether we are just in a soft patch. Looking at some research that's been published during the course of this week from some of the leading banks, I think the verdict still remains that this is a soft patch, and they're citing two principal reasons for the lack of demand at the moment. One being the Japanese earthquake is having supply chain issues across the globe, and the second is the increasing price of oil, which they believe is causing a disruption in demand at the moment. So I think the verdict still remains that the US is not entering into a double dip, but it is seeing some slowing growth. And as we can look through some of the charts today, this is sort of confirming some of those things, particularly here in the UK as well. So let's kick off with the first chart. I'm just taking a look at the US 10-year gilt yield, and really the key observation here is that over the course of the last couple of months, through the slowing economic data that we've seen, the yield on the 10-year gilt has dropped back from 3.6% since it's seen here, back down to 2.9%. So a very steep fall in the yield on 10-year gilts, and it's a move that has been seen similarly here in the UK. Again, you look at this peak in April and we've seen a move there of 3.8% on a 10-year gilt, and that is now dropping down to 3.2%. And I think what both are saying is that that growth slowing at this point means that any chance of rates tightening or going up in the course of the near term is less likely now than was observed back in a couple of months ago. Indeed, if we turn to the domestic market here in the UK, the initial observation was that we may see a rate rise in May or June of this year. Well, that meeting passed earlier this week. Rates are being left unchanged. The forecast is now for a rate rise possibly later this year in November. My own suspicion is that it will be 2012 before we do see a rate increase. So let's just have a quick look at some of the real life impacts that this slowing growth is having on the domestic market. Just going to pull up a couple of equities. The first is home retail. Home retail owns Argos, and this week they issued a trading update which you can see had a very negative impact on the stock price. Argos are warning that numbers, particularly on the revenue side and also on the margin side, are coming under some severe pressure now. Two things may be going on here. Argos may have benefited in the past from being the cheapest on the high street for a range of goods, and that the internet now is opening up that competition and making life just that much more transparent, that Argos doesn't necessarily win the day. But it is also a good barometer of general spend right across the social economic groups, and the fact that they're seeing such large deteriorations in like-for-like revenues of circa 9%, it was a very sharp fall on its share price. Interestingly, they did observe that they expect that they are maintaining market share, and that did also impact on others in the sector that may well be issuing more negative trading updates during the course of the week. And this has impacted on even some of the bluer chip retail stocks like Marks and Spencer. You can see there's been a 10% correction in its stock price just in the course of the last few weeks. So the general theme here is that retail sales are coming under quite severe pressure at the moment and really starting to slow growth here in the UK. Now, it's not all gloomy. One stock that we have been following recently is Halfords, and I just want to, sort of, for reason of balance, to say that there are some growth trends in the retail space. They are quite niche, but Halfords had a very strong trading update this week, particularly on the back of bicycle sales. So the health and leisure side of life still achieving some good sales growth. Now, what does this all mean for the currencies? Well, the pound has maintained fairly consistent move on the currency markets. This was despite earlier in the week Moody's, one of the agencies, warning that the the UK could lose its AAA credit rating should growth slow, or indeed should they shy away from some of the austerity moves that are in place at the moment. It was a warning, nothing more than that at the moment, but it did have the impact of causing the stock market to fall earlier in the week. It has steadied its nerves, and I would say that US stock markets and UK stock markets are hanging on to the bottom end of their trading range at the moment. Temporarily it did cross some of those 200-day moving averages, which are keenly watched by traders, but at the moment markets do feel quite resilient, but towards the bottom end of their trading range. One sector that is continuing to deteriorate at the moment, however, are the banks. We've looked at these over the last few weeks, and this chart here is really to look at the relative performance of banks compared to the rest of the financial markets. And we can see here that broadly through 2009 and to the mid part of 2010, the sector broadly tracked the index of general stocks. But since August 2010, we've seen a marked relative performance deterioration in the banking sector at the moment. And there's no sign at the moment that it's correcting, but a few buy notes coming out from Lloyds this week suggest that some of the bigger houses out there are looking at this as maybe the turning point for the banks. But at the moment, the relative performance is very poor. And one final chart I want to leave with today is oil. Brent crude is starting to tick up. It's hitting $118 at the moment, and as you can see there, having fallen off following the speculative run on Middle Eastern concerns, we're starting to rebuild a bit of a trend to the upside here. This does act as a bit of a break on the US economy, so some headwinds here for the Western world.